You got a great idea for a new business. Fantastic. But how do you fund it? We'll find out. Then we'll discuss climate change and your investments and ways to build an income-producing portfolio. All this and more today on The Wealthy Life. Welcome to The Wealthy Life. Have an idea for a new business? How are you going to fund it? Joining us today is successful entrepreneur Rob Fraser to share some tips he learned on how to get the money you need. Rob, welcome to the show.
Thanks for having me. So excited to be here.
Well, tell us a little bit about your journey.
Yeah, so in my former life, I call it, I was a professional mountain bike racer. 10-year kind of career there, 5 times on the national team.
Well, that's pretty cool.
Yeah, it was super exciting. Little different today as an entrepreneur, but I still call it the sport of business, which I kind of like. So after retiring from that sport, I was like, what do I do next? So starting a business in kind of the athletic space seemed kind of like a natural progression, another big goal to work on. So I founded a company called Endure, which is a performance stock brand based here in Victoria, BC. And
what do you do with the company?
We make primarily performance socks. So the idea initially was the sock space I felt had been left behind by the athleisure movement, meaning there wasn't a great all-day performance sock that was also designed for expression. As a cyclist, as well as a guy who primarily wears black, my socks were a way that I expressed myself. So I was like, why isn't there a great all-day performance socks I can run, go to work, go to school, and then do everything else in that also looked great and I could kind of express how I'm feeling that day.
Okay, so you had this great idea to sell socks.
Yeah.
But you need some money to start a business, don't you?
You do, yeah, it tends to help. So I what we call bootstrap the business. So I didn't have any money, I was in school at the time. So I had about $1,000 I put aside for my school loans and invested that, basically get the business started that looked like buying inventory, setting up our website. And from there I was like, well, now I need to sell these socks to capture more money to reinvest.
So you started with literally $1,000.
Yeah, literally $1,000. That's all I could afford to put in.
Yeah.
Bought the inventory, it was about 250 pairs of socks, took them to school in a Tupperware and sold them one by one to people. And I knew my margins. So for every pair I sold, I basically doubled my money, took those profits, reinvested and bought more socks and kind of kept doing that.
So that's what you mean by bootstrapping. Like it's literally like start small and then compound growth over time.
Yeah, quite literally pull yourself up from the bootstraps, find a unique way to fund yourself and use that money to reinvest. And look, it can be a slow way to grow, but there's other ways you can get unique as well and get more cash as you go.
So over time, have you needed to access more cash or has that been the success of your business, is just one step at a time?
Pretty much that's been the success, but I took a step back and asked myself, are there other ways that we could sell socks? And one of the realizations was that we could white label socks for other larger businesses. This could be brands that are given away as promotions, conferences, et cetera. So we're using bulk purchasing to sell a lot more socks at volume that we're then using that cash to fund the inline side of our business. We're just selling individual
pre-sale?
Pre-sale, exactly. So customer comes to us, says I need 1,000 pairs of socks for a conference. We sell it to them on that day. We then have a 30-day production cycle and then 60-day terms. So it's 90 days of free cash flow and we know our margins. So we save what we owe for the product, reinvest our profits immediately into the brand and kind of grow that side.
Oh, this reminds me, when I was in business school, we had an entrepreneurial project. We had $5, that was it. And we had a contest. We broke up into teams and we had to see who had the best, most successful business only investing $5 of capital. And you know what the secret was?
What's that?
Pre-sale.
Yep.
Spent the $5 on getting order sheets and pens and going around getting people to order flowers for delivery. And we collected all the money first, then we placed the order, delivered and sold, didn't need any capital up front. But the reality is most businesses don't work that way. And had you had a lot of money up front at the beginning, you may have achieved growth faster. What are some ways that business owners can access more capital?
Yeah, there's lots of ways. I would caution having too much upfront too, because I think part of business is learning how to spend money wisely. I think if you're given a lot as an early entrepreneur or new business owner, it's really easy to not create great habits around using your capital in the business. So
That's
bootstrapping
a
does.
really good point.
Yeah.
Yeah, because if you got a bunch of money sitting there, you might spend too much on things that don't matter.
Yeah, it doesn't put you in that position of creativity where adversity creates creativity, and like you figure out how to maximize your capital. If you have too much, then you're going to make some decisions that maybe are not wise. But other ways, there's the BDC, which does some early business financing. Van City was really great for us. They gave us a $10,000 line of credit right off the bat. So there's a lot of non-dilutive capital ways to raise capital these days that aren't selling equity.
Yeah,
They exist.
non-dilutive. I mean, it's really about if you want to retain ownership.
Yeah.
So if you sell equity, which is essentially getting shareholders or partners in your business, you are giving up some of the control, as opposed to the other methods you just talked about is borrowing money. So it's a loan that you do have to repay with cash flow, but you keep the ownership.
Yes, for sure. I mean, people would look at maybe the interest owed on that loan and be like, that's an expense. However, equity is an expense too in the early days because it is the most valuable thing in your company. So you want to ask yourself, if you're going to sell equity early, is it for a good valuation? Do you have leverage? Is it a good partner? Because as you mentioned, you're bringing in shareholders, and the second you sell a piece of your company, you're bringing in another voice. And if that voice is not aligned with your vision and mission, it can get quite difficult.
And make sure you have an exit strategy planned out. But if you bring in shareholders at the beginning when maybe the company's only worth $1,000, and then one day all of a sudden it's generating 10 million or more in revenues, oops, you may have preferred to keep all that yourself.
Yeah, I mean, look, there's no perfect situation, and people do different mechanisms for different reasons. And I've seen both sides work, but it's definitely, if you can avoid raising capital in the early days, I'm a big fan of bootstrapping, friends and family debt, find people that can help you, and get creative with your business model. There's ways to get capital out there for sure.
Rob, thank you so much for being with us today. That was fantastic information.
Thanks for having me.
And don't go away. Your investments can help fight climate change. Learn how after the break.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. How does climate change affect the investments in your portfolio? Director of Sustainable Investing, Martin Groskoff, is with us today to share some valuable insights. Martin, welcome.
Thanks very much. Pleasure to be here.
So Martin, you were a bit of a pioneer when it came to responsible investing and have devoted your entire career to this. What prompted that?
Well, I used to work in an industry, engineering consulting, where I was an environmental scientist, and I spent a lot of time actually dealing with environmental impact in many of the Canadian resource sectors. So at one point in that career, I said, well, wouldn't it be nice to sort of direct capital in a fashion that dealt with the issues as opposed to trying to clean them up afterwards? So that's really what got me interested in moving over to finance.
And it's so great to see many clients asking that same question when it comes to investing, so that they can hopefully align their values with their investments and still earn a great rate of return at the end of the day. Let's talk a little bit about climate change. How does climate change affect portfolios, or the other way around? How can your portfolio impact climate change?
Well, look, there's a lot of risks and opportunities associated with climate change. I mean, we've all seen the issues with flooding and fires. Those are going to become obviously far more prevalent as climate change accelerates. So it's impacting everyone's portfolio today. In the longer term, the opportunities are huge in terms of transitioning away from, what's a carbon-based economy today to one that uses a lot less fossil fuels and much more renewable power, as an example, or electric vehicles, as a solution for our transportation sector.
Now, the transition period isn't quick. What do you anticipate for a transition period? How long do you think it's going to take us to get from fossil fuels to electric or some other alternative greener energy?
Well, look, I've been working on the issue for about 20, 25 years, and we're just scratching the surface. So we've got a long runway ahead of us. You've seen Canada and other countries make 2050 commitments to going net zero in terms of carbon emissions. Many companies are embracing those targets. So this is a long runway. This isn't something we're going to solve, over the next 3 or 4 years. And from an investment horizon, it's actually a great tailwind in terms of those long-term opportunities that we see.
So for the typical client who maybe has some heavier investments or exposure in their portfolio to some of the fossil fuels, is there anything they should be doing differently? And does it have to be done today, or can they wait?
Yeah, I think investors, do have time to make changes because this is a very long-term issue. There's still a lot of transitioning that needs to occur as we move from, as I mentioned, those traditional industries to ones that are more advanced in terms of their ability to reduce emissions. So it is something that I think portfolios will reflect over time. But of course, the earlier your position, perhaps the better the chance of reaping the opportunities.
And when it comes to some of those maybe traditional investments, there's lots of different companies that provide exposure there. Are some companies better than others? What should investors be looking for to make sure that where they're investing their money does align in the right direction going forward?
Well, look, I think there's been so much dramatic change over the 20 years that, I've been engaging with companies in the public markets. It used to be that these issues were simply not discussed, with corporate boards. Very different today. I think any company that's of a certain market size is trying to figure out how they best can address these issues in their business. So transition is a topic now of senior executives in the board level. And really, there's a lot of help out there in the market in terms of ratings and how companies are doing on environmental issues that can, assist investors in making those decisions or finding the right portfolios and managers that help them do that.
Yeah, because I hear from investors today that quite often say things like, well, geez, I see the future is in wind or in electric, so everyone's going to move there. Get out of your oil and gas stocks today. But that's a bit of a panic reaction, is it?
I think so. I think you want a greater percentage of your investments to be reflected for these long-term opportunities. And that's the key. It doesn't mean that you're wholesale changing 100% of your portfolio to those more long-term solutions, because there still is a lot of profitability in the companies that exist today. It's just that we need to be mindful things are changing. It's sort of like those who were invested in Amazon a few years ago. They had the foresight to say, okay, well, that's going to take over e-commerce. Well, I think there's going to be a lot of businesses like that around energy transition that will be very profitable opportunities for investors.
And final comments, what are the two big sectors that you think are probably going to have the biggest impact going forward over the long run?
Well, certainly I think transportation is just ripe for disruption. I mean, Tesla was sort of a company that broke the mold. It's a traditional auto manufacturer in the sense that, it's selling a vehicle, but it's doing it in such a different style than the conventional OEM. So I think, it's the auto industry and perhaps transportation more broadly. The move to electric buses and better forms of transportation is a huge opportunity. And then when we look at agriculture and food, health and nutrition associated with that, how you actually can grow crops more environmentally friendly and have better nutrition in those products. That's another huge disruptive area that we are focusing a lot of time on.
Martin, some great things to consider. Thanks so much for joining us today.
Thanks so much.
And stay tuned. Learn how to generate income from your portfolio when we return.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. Are you looking to generate income from your investment portfolio? Joining us today is portfolio manager Jim Grant to discuss a few ways to build an income-producing portfolio. Jim, welcome to the show.
Thank you, Sybil. I'm happy to be here.
Now, what's the number one reason people want to generate income from their portfolio for?
I think the reason people want to generate income from their portfolios is to fund their lifestyles, right? For like a retiree, for example, who say you're retired age 60, 65, and you built up a nest egg, and you need to be able to tap into that to fund your living expenses. So that's what, if you're going to do that, you don't want to be cashing in your investments all the time. What you would rather have are investments that are generating income, generating tax flow that can be flowed out to you to cover your living expenses.
Well, that makes a lot of sense because before retirement, people are working so hard at saving. So they're putting their money away and they're getting the compounding growth. And most portfolios actually do pay some sort of income, but when you don't need it, you just keep reinvesting it. You don't notice. So now you're retired, you're pulling some income. What are the 3 different ways that income can be generated from a portfolio?
Yeah, the main 3 ways would be through interest, dividends, and capital gains. With interest, it's kind of the safest way to generate income. You are buying something like a GIC or a Government of Canada bond that's paying you X amount of interest for a period of time, and then at the end of that period, you get your money back.
Yes.
Dividends will come from buying stocks in companies, profitable companies that are earning money and paying out a portion of their profits to the shareholders, which would be you, in the form of dividends.
Well, I like getting dividends. And what's the 3rd way?
Yeah, capital gains would be the other way. And what that is if you buy a stock and at some point in the future you sell it at a profit, then you're generating what we call a capital gain.
Perfect. I like the sounds of capital gains too. Now, dividend income, how often do dividends pay?
It varies, according to the investment. Sometimes a company might pay it quarterly or semi-annually, but that would be a typical dividend would be quarterly, I would say.
Okay, and interest income, how often does that pay?
Well, if it's a bond, it might be every 6 months. It could be more than that. It could be less than that. It just depends again on the investment.
Okay, so every investment has a different income paying schedule. And capital gains, obviously, you only receive that gain when you sell it.
Correct.
Yeah,
Yes.
so that's at some point. So when structuring an income producing portfolio for a retiree that's maybe looking for monthly income, what are some of the things that need to be considered?
Well, you can use the various types of investments that we've discussed, whether it's bonds, dividend-paying stocks. And basically what you're doing is you're creating a pool of cash that you can draw from. So, the dividend doesn't have to come in every month. It could come in quarterly, but you have a little bit of cash set aside that you can pay out interest or income monthly.
Right.
And every 3 months or 6 months, depending on the investment, that pool of cash is replenished. And that's a good way of having it so that the income is sustainable.
Now, what happens in the case where someone wants to pull out more than their portfolio is generating in income? What happens?
Yeah, that's a good question, because with interest rates where they are now and dividend yields be respectable but still not where they've been historically, that's often the case, that interest income and dividend income is not enough. So that's where you want to maybe tap into your capital growth.
Yes.
That's where capital gains come in handy. But if you're going to do that, you have to do it responsibly, and you have to be strategic about it, because you don't want to be selling your stocks every month, because as we know, the markets go up and sometimes they go down, and you don't want to be selling your stocks when they're low.
And you don't want to sell a stock that's paying a really good dividend.
Well, you would rather not. That's right.
Yeah. So if after all that's considered, people may find they need to start dipping into their capital. Obviously, people ideally would like to avoid that, but is that okay?
Absolutely. In an investment portfolio, if you are going to own stocks that are paying dividends, typically the dividends go up over time, but so does the underlying capital, because the companies are making money. The good companies are making money and they're growing, and as they grow, their stock prices go up. And that's generally, usually, or at least in the last few years, that's been kind of the bulk of the investment returns that people have been earning. So it's absolutely okay to tap into that from time to time.
But the only way you're going to get capital gain income is if you invest in stocks. So good quality stocks in a diversified portfolio mixed with some bonds, and you've got the magic recipe.
Absolutely, yes.
Jim, thanks so much for being with us today.
Okay, thank you.
And up next, should you give the cottage to your kids now or after you pass away?
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Beatrice. Dear Sybil, my husband and I own a beautiful cottage that the family has enjoyed for many years. As we are now in our late 80s, we are wondering if we should give the cottage to our 2 kids now or wait until we have passed away. Which is the better option to consider? Warm regards, Beatrice. Well, it's a great question, Beatrice, and an important one to think about now. Will you still have some options to consider? First thing is, do your kids want to keep the cottage? Do they plan on sharing it together? And do they want to become business partners? Because that's essentially what you're asking them to do. If the answer is yes, and they get along great and they agree on everything, then maybe it is a good idea to give it to them a little bit earlier. Of course, there's some tax implications of doing so. Because this is a second property of yours, it's the cottage, by transferring it over to your kids now, you are going to trigger capital gains tax, assuming you have a profit on the property, which, given that you've owned it for many, many years, it's likely the case. Now, that being said, triggering the taxes now may be less than triggering them later. What if you and or your husband live until you're 102? What will the real estate value be 22 years from today? That might be more profit taxed at potentially a higher rate down the road. So something to think about. With your 2 kids, involve them in the conversation. See if they will agree on who's going to take care of the property, maintain the property, who gets to use it and when, and who is going to pay for the maintenance, or are they going to share the expense. And maybe you want to fund some of those expenses during your lifetime. Lots to consider, but I hope that gets you on the right track. And that wraps up this edition of The Wealthy Life, helping you make smart financial decisions. Join the Wealthy Life Club and you'll gain access to everything you need to live your version of the wealthy life.